Okay, it's on now.
The broadcast is now starting. All attendees are in listen-only mode.
Good evening and welcome to India Ratings webinar on Credit Outlook FY16 for it's our economic outlook. I am Saranya Shetty, Manager Corporate Communications and Investor Relations for India Ratings and your host for this webcast. In this edition, we will be discussing the economic outlook that was released last week. Our presenter for today is Dr. Sunil Sinha, who's our Principal Economist and Director of Public Finance. Before we kickstart this session, few housekeeping announcements. You can ask us a question anytime during the presentation. To type a question, you need to click on the question dialog box and type in your questions. As soon as the presentation is over, we will be open to take your questions. So without much ado, I would like to hand over the session to Dr. Sinha. Dr. Sinha?
Yeah, thank you, Saranya, and good afternoon to everyone. My name is Sunil Sinha, and over the next 20 to 25 minutes, I'll take you through India Economic Outlook of India Ratings and Research. But before I do that, let me quickly give you a snapshot of the sections or the topics that I will be covering during my presentation. The presentation is broadly divided in three parts. The first one is that irrespective of at what stage or at what growth level the economy is, economy continues to face certain challenges. So what are the macroeconomic challenges at this point of time that the economy is facing will be the first part of my presentation. And all of us know that in the last 20 or 25 years or so, the integration of Indian economy with the global economy has gathered pace. As a consequence of that, a lot of growth prospect of the economy is also very closely linked to what's happening elsewhere in the world. So I'll briefly talk about the global context, and then we will, or I will discuss about the Indian economy. So let me first take up the macroeconomic challenges that the economy is still facing. In fact, the whole length and breadth of the overall global economic landscape has undergone a substantial change in the post-2008 period. And if you look at the period from then till now, the broad message that one gets is that global recovery is still not at the level at which it was around before the global crisis happened. There are, economies which have done or have somewhat recovered, and then again went into some kind of a recession. India is a prime case. And also developed world, I mean, although the recent data shows that the US economy has done relatively well in the second and third quarter of 2014, but if you look at the Eurozone, if you look at China, if you look at Japan, and if you look elsewhere in the, say Australian continent, or for that matter, African or Latin America, I mean, there are mixed signals. So on the whole, the global recovery is still quite uneven and fragile, and obviously the global development, feeds into the Indian economy both through the trade and non-trade channels. So that to a large extent does impact our economy. I will be discussing a little bit of that in detail at a later stage. In the domestic context, fiscal health has been an important issue because this not only has a rating implication for the sovereign, but also more importantly, the issue is that to what an extent it actually crowds out either the private investment, or to what an extent it actually impacts the capital market by having the higher rate of interest and so on and so forth. Then coming to inflation, if one looks at the inflation number at this point of time, then obviously inflation numbers look much better as compared to what they were probably even 6 months ago. So to that extent, yes, inflation doesn't appear to be a challenge as of now. And as a consequence of that, only a few days back, we saw RBI actually reversing the cycle. But on the whole, the challenge on the front of inflation is far from over. Infrastructure is a story which is going to play out in the Indian context, even in the medium context. Forget about the short-term or near-term context, because we are hugely deficit so far as infrastructure is concerned. So in this context, it is absolutely critical for the economy to focus on that. And we have been listening about infrastructure focus from the side of the government, not only from the present government, but also from the previous government. But despite that, the deficit is still huge, and my own view is that we may improve upon the infrastructure over the next, say, 5 years or so through a concerted effort, but it's unlikely that we will be able to wipe out the deficit. So infrastructure is an important and will remain an important challenge so far as India's growth story is concerned. Then looking at manufacturing, there is a lot of talk on manufacturing these days. In fact, Make in India is one of the slogan that the present government is focusing on to attract investment, not only from the domestic players but also from the external players or through FDI and so on and so forth. So manufacturing is critical because without that, meeting the employment objective of the economy will simply not be possible. And the currency and the balance of payment situation, particularly the current account deficit as of now looks in a much better shape than what it was, say, in 2013-14. Given the fact that oil prices have come down substantially, and there are checks and balances so far as gold import is concerned. So on the whole, current account deficit at this point of time is looking much better. But you see, the problem with the current account is that if economy picks up and global economy doesn't pick up, then exports will not get the fillip, whereas imports will get a fillip. And that may actually widen the current account deficit. So under that kind of a situation, will the capital inflows will be sufficient to cover up the current account deficit will be a question that many of us would be watching or would be interested in. So with these broad contours of the challenges that are in front of the country, let me move on to what's happening in the global economy. Now, this slide, which is on the screen at this point of time, gives you an idea as to how the growth in the Indian context has, panned out over the last 20 years vis-a-vis the global growth, particularly in the advanced economies. Now, if you look at the cyclical nature of the overall the movement of the curve, then you will see that there is an uncanny similarity between the the growth trajectory of advanced economies or the cyclical movement of the advanced economies as well as the movement of Indian growth story. This is not some happened in the last 10 years or so. This is happening since way back in 1992, I mean, when the economic reforms began. So in other words, to believe that Indian economy can ignore what's happening in the global economy and still grow at a very rapid rate is something which is very difficult to visualize. And we have seen time and again that whenever there has been a dip in the global economic growth, the similar dip has been witnessed by the Indian economy. However, if you look at the trend growth rate, then the story is somewhat dissimilar, because cyclical movement may be similar, but the trend story is somewhat different. In case of advanced economies, we clearly see that, say, around the annual growth has been consistently dropping over the years. I mean, in other words, if you take a long shot about the prospect of advanced economies, for advanced economies to grow even at 2% on a sustained basis year after year will be a huge challenge in the future. On the other hand, if you look at India, in India, I mean, even though there have been fluctuation over the years in terms of the GDP growth, but if you look at the trend growth rate, that the trend growth is showing a sustained upward movement. That simply means that the potential for growth in India remains, and overall, despite fluctuation, the long-term short or long-term view of the Indian economy is that it is likely to grow faster than in the previous years, and just the reverse is true so far as advanced economies are concerned. Now, this has huge implication, particularly for businesses who are really looking to, tap overseas market. So when you have to tap overseas market, then what are the economies where you should focus? By this, I'm not saying that the company should not look at advanced economies either for acquisition or mergers or expansion of their market. But all that I'm saying is that the growth rate is likely to be faster elsewhere. I mean, if you replace India with the emerging economies, the picture doesn't change. So the opportunities for Indian corporates to really grow faster or to grow their exports faster, they should focus more on the emerging market rather than the advanced economies. With this backdrop, let me just give you an idea as to where the current state of affairs is so far as global economy is concerned. I haven't, plotted the graph for all major economies, but the three major economies which I feel are critical or very, very important so far as Indian economy is concerned are US, Eurozone, and China. And in each of these three economies, if you see, except probably US, which is expected to grow at about 3.1% in 2005 and around the same level, about 3% in 2016. Things are not looking very good elsewhere. I mean, China, the growth is likely to decline. Eurozone, there is going to be some pickup in growth, but those levels of growth will be very, very low. So in other words, the problem for Indian exports will continue so far as these important global economies are concerned. The problem with the US is that much of the recovery that we have witnessed in the case of US is largely because of the government stimulus. I mean, they have not happened because of the private demand or private investment. So, I mean, the challenge for the US economy will be that so long as they are not able to translate the government push into the private demand and investment, sustaining this growth momentum will be very difficult. The challenge for the Eurozone is that deleveraging, austerity is still continuing there. I mean, now again we have started hearing the problem with the Greece because Greece is again asking for another bailout. China, again, the problem is that China was an export-led growth story. So if things are not looking good either in US or European area, then obviously China will have to remain satisfied with the fact that their exports will not grow at the same rate as it was in the past. So on the whole, their focus has shifted. They are now focusing more on the pumping up the domestic demand, but that is still not a substitute for the global demand. And that is the reason why the likelihood is that, and it is associated with a lot of other things. So Chinese government is also in the mode of controlling a lot of risk which the economy is, plus the shift from global demand to the domestic demand will take its own time. In fact, in case of India, roughly around 60 to 65% of our overall demand comes from domestic demand. In case of China, it is just about 1/3, about 30%. So that's the difference. So with this overall backdrop, let me move on to India. What is up on the screen is our forecast for FY16. So broadly, what we are expecting is that, or what we are trying to state is that the Indian economy has bottomed out. So from here on, if things continue the way they are and if there are no shocks, then the likelihood is that the economy will grow at 6.5% next fiscal. Our estimate for the current fiscal is 5.6%. And the key driver for this growth is going to be the industrial recovery. And industrial recovery, which we, say for example, industrial growth for this fiscal. Earlier we had expected this to be a little higher, but now we estimate that it will at best grow at around 3.6%. However, next year we are taking the industrial growth at 6.5%. Services sector has been a robust performer, although it's nowhere near its peak, which was close to double digit. It has fallen from there, but it is still much more robust than the other sector. So that is still driving the overall growth. So we expect the services sector to come in at around 7.4% next fiscal. Within industrial sector, we believe that the key impetus is going to come from electricity and manufacturing. Electricity, has been doing well now almost for a year. I mean, it's growing at double digit for several months. I mean, if you look at the IIP data. And we hope, or our expectation is that it is likely to do well even in the next fiscal, although not in terms of YOY growth, not as high as current fiscal. Part of the reason, of course, would relate to the base effect, but also with the fact that the coal issues are likely to be sorted out shortly. And with the commodity prices down in the international market, even the prices of the imported coal are not going to pose that kind of problem as they were posing in the past. So this will continue to be a growth engine so far as the economy is concerned. But the main impetus is going to come from the manufacturing. With the focus of the current government is on manufacturing. And also the fact that the base of manufacturing is very low. So both of these will get translated into a higher YOY. I mean, construction will continue to grow, not so much because action will happen in the urban areas, but more so in the rural areas. Firstly, because the last year's monsoon was very good, so that created some kind of a income effect, and that of course translates into construction. This year monsoon hasn't been as good, but it hasn't been as bad as we expected it to be at the time of the beginning of the monsoon cycle. But by the time monsoon season ended, it was quite obvious that monsoon has been bad, but not so bad. So, and this is also getting reflected in agricultural, growth. I mean, the second quarter agricultural growth didn't turn out to be as bad as we had expected. So, both of these should give some cushion to the rural demand, and that will provide some impetus to the construction sector. Well, I mean, coming to the inflation bit, inflation, as you can see from the graph, had been very high, but it peaked in 11, and since then it has been gradually declining. And with the collapse of commodity prices, particularly the crude in the international market, and the likelihood that at least in the foreseeable future, which means about in about next 1 year or so, the crude prices are unlikely to go back to the same level. So if that's the scenario, then we believe that that will be a huge positive for inflation, and also the fact that the minimum support prices for the agricultural commodities, which were rising pretty fast in earlier years, have did not rise in the same proportion this fiscal. So that also will have a dampening effect. So net, and also with the government focus on removing many of the supply side bottlenecks, the likelihood is that the inflation will remain soft, although marginally higher than. We expect the average WPI inflation to come in at around 2.7% in FY15, and we expect it to only go up marginally to 2.8% in FY16. Now, with this kind of inflation expectation, it is quite obvious that it will have its impact both on monetary policy as well as the yield on the G-Secs government bonds. And RBI just few days back cut the repo rate after a gap of almost 1.5 years. So the the repo is now down to 7.75 and reverse repo to 6.75. Our own view is that because inflation, not only inflation, but even inflationary expectation is quite down. In fact, the September inflationary expectation of household survey, which RBI conducts, was showing inflation to be around 15 to 16%. In just about 3 months, that has fallen to something like about 8 to 9%, and the likelihood is that in the next cycle it will drop further. So under that circumstances, obviously, RBI will continue to tinker with the policy rate, and our expectation is that in FY16 we can expect another 75 basis point cut in the policy rates. As a consequence of that, or for the, not only as a consequence, but also in anticipation of the fact that the rates will be cut, it's only a matter of time. Bond markets had started reflecting that. So the bond yields, which were which had peaked around 8.9, 8.8, came down sharply in the last 2 to 3 months, and it has in fact fallen even below the so-called floor rate, which is the repo, and it has fallen to something like 7.9, and on average it was around that level for the last 2 to 3 months. And at the moment probably it is trading somewhere around close to 7.5 or so. So we expect that now that the monetary easing cycle has begun and there is a likelihood of further cut in the repo rate in the coming fiscal, the fiscal year end yield on 10-year benchmark government bond would trade somewhere between 7.1 and 7.2. Then finally on the external sector, as I told you earlier that the things on the external front are not very good so far as export is concerned, and there is a likelihood that there will be some pickup in the domestic economy which may push up the import somewhat. So as a consequence of that, we believe that the overall current account deficit may widen as compared to the FY15. But again, that will not have a very negative impact so far as currency is concerned, currency broadly will remain stable, but the fact of the matter is that I mean, see, the problem here is that we are our forex reserve, rather than depleting, they are actually getting strengthened. So under such circumstances, the usual trend that rupee should take is that rupee should strengthen rather than getting weakened or remaining stable. But what we have seen is that rupee has somewhat depreciated from the level at which it was in around June 2014 to the level at which it is now. And part of the reason is not here dictated by the fundamentals, because if one looks at the fundamental, then the fundamental would suggest that the rupee should have appreciated. But it has not, and the reason is RBI's intervention, and also the fact that the dollar index has strengthened against almost every currency in the world. So these two had its impact on currency, and currency has broadly been somewhat range bound. I mean, 61, 63, and so on and so forth. So by the end, in the fiscal year 16, our take is that the average rate for INR vis-a-vis US dollar would be 63. Most our projection till FY15 is, with respect to currency, our projection for FY15 is that we are expecting it to trade somewhere between 61 and 62 by March end. But the number that we have projected here, 63, is not March end number. That's actually an average value of rupee vis-a-vis dollar for the entire fiscal year. So there is a slight difference there. So that, I think, is the broad situation. On the fiscal front, what we have seen is that things have somewhat improved on the fiscal front, because the kind of stimulus government had to undertake immediately after global crisis had reversed the trajectory of fiscal deficit, and fiscal deficit, from an international perspective, was considered to be very high. It has crossed 6% in FY10. Since FY12 it has been coming down, and the expectation is that, although the budgeted fiscal deficit number is 4.1%, we expect the government to end the fiscal year at around 4.2% of GDP, and we expect that it will come down further to 3.9% in FY16. However, if you look at the other graph, which is revenue deficit as a percentage of fiscal deficit, then you can clearly see that there is a difference. If you look at the fiscal deficit coming down between 2003-4 to 2008, then you will see that the fiscal deficit has been accompanied by that revenue deficit as a percentage of fiscal deficit also declining substantially. In fact, the revenue deficit as a percentage of fiscal deficit in FY08 has declined to something like 42%. However, this time, even though the fiscal deficit is declining, but revenue deficit as a percentage of fiscal deficit hasn't come down that much. This clearly indicates or points towards the quality of the fiscal deficit, which simply means that most of the borrowing are not used for capex. They are largely used for revenue expenditure, and which is something which is a cause of concern, because in the last two budgets, and in all probability we are going to witness even in this budget, that fiscal deficit will be attained not by compressing the revenue expenditure, but it will actually be attained by capping or cutting the planned expenditure, or in other words capital expenditure, which is not very good so far as the medium-term growth prospects of the economy is concerned. But nevertheless, I mean, that's what the government has been doing for the last 2 to 3 years. So, I mean, this is something which certainly is a cause of concern, and particularly in the context when investment is simply not picking up. If public investment also gets curtailed, that then overcoming the supply side bottlenecks or the infrastructure deficit challenge that the economy is facing will pose an even bigger challenge, because it's unlikely that under such circumstances private sector will step in. So with this I'll stop, and if there are any more questions or any questions that you have, then I'll like to address that.
Thank you so much, Dr. Sinha. As mentioned by Dr. Sinha, you may now post your questions for the presentation that was just made. We already have a few questions with us. I would request Dr. Sinha to please help us with the same. The first question here is, despite new and stable government and improved business sentiment at the ground level, investment is not picking up. Why do you think so?
Well, you know, no doubt with the new government and also the kind of signals that the government has given till date, the business sentiments have really become quite strong as compared to what they were, say, about a year ago. And this is clearly got reflected both in the vibrant Gujarat Summit as well as the global summit which West Bengal hosted a few days back. And also the fact is that if you look at the Cabinet Committee on Investment, they have given clearances to large projects, a number of large projects which were stuck due to one or the other reason. However, despite all that, the investment at the ground is just not picking up. And the reason for that is threefold. The first, of course, I stated that to meet the fiscal deficit target, government has been slashing its capital expenditure. So the government capex is not coming forth. Now, expecting the private corporate sector to fill in that gap or to come forward, particularly in the infrastructure. I mean, if you look at the manufacturing sector, there are a large number of manufacturing sector where because of the tepid demand and the conditions of the last 2 years, I mean, there is already an overcapacity. So they will not undertake new investment. But in infrastructure, yes, there is a deficit, so there is a genuine need and desire. But the unfortunate part is that most of the infra players, their balance sheet is already stretched. And the balance sheet of bank has deteriorated mainly because of the infrastructure companies not able to meet their obligation. So both these key players having their balance sheet stretched simply means that they don't have the capacity to undertake huge investment so long as they don't repair that. And that will take its own time. So under such circumstances, the push or the should have come from the government, and unfortunately that is also not coming. So this is part of the problem which economy is facing.
Mm-hmm. All right, thank you so much for that one. We have another question from Prashant Biradar. This one's, when we look at the growth story of agriculture part, it is in declining stage. This may result in impact on inflation on higher side in coming financial year and also incline in. Do we think that presently still the economy is in a gloomy stage?
Although agriculture's contribution in overall GDP has come down to something around 14%, but its importance should not be understood only in terms of what it contributes to the GDP. I think the bigger question that has been raised is that if agriculture doesn't do well, then it actually impacts the economy via inflation, which has across the board impact. And but our view is that at this point of time, as I said right in the beginning, that inflation continues to be a challenge, and part of the reason for the agriculture is that the productivity has been stagnating in agriculture. There are supply side issues. This government, as well as the previous government, they have understood the problem, but the problem with the agricultural sector is that there is a huge lag. I mean, in fact, the problem that we faced in the last decade, or we are facing till now, is mainly due to the belief that, agriculture would also invite private investment the way the other sectors invited private investment during the 90s. Unfortunately, public investment has a much bigger role to play in the agricultural sector, and private investment doesn't flow in agriculture the way they flow in industrial sector. So, in the last decade, that folly was understood by the government, and from somewhere around 2003-04, government started corrected that. But again, I said that these things play out in the agricultural sector with almost a lag of 5 to 10 years. So now that the corrective measures have been taken and focus has shifted back to addressing the issue of productivity, there is a talk of going to those areas where productivity is low. So you have Look East policy. So some of these areas, Eastern Uttar Pradesh, then Bihar, West Bengal, Assam, these are being the focus of government to actually raise agricultural productivity. So I'm not so worried about whether we will have enough food to eat or not. Now the issue is that at what cost these food will be procured. Now that is where the productivity kicks in, and unless and until, and that's more a structural issue which will take its time to play out, and even if the previous, whatever steps have been taken so far will take its own time. The other issue, of course, relates to the supply side issues, which relates to agri infrastructure, and more relates to those agri commodities which are more seasonal in nature, say fruits, vegetables, etc. So their government has set up a stabilization fund, and hopefully that should also have some impact, along with the fact that there is a serious talk of dismantling the APMC Act and allowing the private sector to participate in the mandi business and so on.
The next question here is from Mr. Dilip Panchal. What happens if the Indian government increases borrowing for capital expenditure?
Well, look, the current, many commentators have begun to suggest at this point of time. If you look at, a report that was released by HSBC yesterday also talks about it. ASSOCHAM has already talked about it in the past. Our own outlook talks about it. The issue here clearly is that given the current state of affairs, about which I already elaborated, neither the private corporate sector nor the banks have or are in a position to really infuse a huge dose of amount into the infrastructure. So under such circumstances, it is absolutely critical for public investment to flow in. And if public investment don't flow in, then infrastructure sector will not pick up. But again, all of us know that the constraint with the government is that government has a substantial portion of its revenue goes for what is called committed expenditure, which is salaries, pensions, and interest rate on the past borrowing. Now, if a substantial portion of that revenue goes for the very little is left for undertaking capital expenditure. So under such circumstances, if government borrows and use it for capital expenditure, then I don't see a harm. I mean, even if the fiscal deficit doesn't fall from maybe about 4.1 or 4.2% to 3.9%. And I think this is the point I was trying to make when I was saying something about quality of fiscal deficit. And this is not something which people don't understand. I mean, most of the investors, most of the people who watch government actions closely do understand. So if government shows its resolve that whatever money I'm borrowing, I'm not using it for meeting my day-to-day needs or consumption needs, but I'm using it for creating infrastructure or I'm using it for capital expenditure, I think there is no harm, and because that will only increase the growth potential of the economy, which simply means that if your growth rates are higher, your tax revenues or tax buoyancy would be higher, and eventually you will be able to repay the loans that you have.
Okay, the next question here is from Depupam Chaudhary. With US interest rates slated to go up as the economy recovers, what is your opinion on its effect on India, especially in the context of FII outflows?
Look, I mean, so far as US economy is concerned, I mean, or particularly, I mean, the Fed is concerned, they have, given a roadmap. I mean, to a large extent, the market expects the US Fed to adhere to the roadmap. And even though the likelihood is that maybe the first a round of rate increase in US economy may come around April and thereafter, but as the Fed chairman has indicated time and again, that most of their action will be transparent and most of their action will be guiding the market well in advance. So it's unlikely that there will be any kind of a shock for the market which can bring about some kind of a turmoil or some kind of upheaval. And also the fact that when finally the Fed ended its bond purchase program as it has stated earlier in the month of October, there was no ripple effect in the global capital market, simply because global market had anticipated that and they had adjusted for that. So long as Fed follows a path which is more or less kind of told or narrated earlier, and global financial market do not get surprised by Fed's action, I don't think that it is going to have much impact. So if global financial market don't get into any kind of a turmoil, then sudden pressure on Indian economy, particularly on the capital account, is not going to be there. I mean, as we saw in the month of October, I mean, the Fed action was announced, but hardly anything was felt on the Indian market. So my sense is so will be the case, or the likelihood is that so will be the case in the future as well.
Okay, the next question is from Mr. Ajay Partale. If crude price further reduce sharply, will it affect our economy?
Well, so far as crude prices are concerned, obviously the level at crude prices were, given the level of growth which either the developed market or developing market were witnessing, was not justified. I mean, it was simply not there. And add to that the shale oil and gas recovery. So all of that obviously changed the complexion of the demand and supply of oil in the global market. And the net result has been that the oil prices dipped substantially. Now the question is that the oil prices have already fallen to a record level. I mean, it has tested the 40s now. Now the real issue, I guess, is can it fall further, or what will be the situation in the near term? As I said, I mean, in the very beginning, it's unlikely that oil prices will go back even anywhere close to $100 a barrel. It'll more be, in around 50 plus minus kind of a situation. Because the shale gas discovery, about which the thinking not just about 2 to 3 months ago was that if the global prices fall below 75 a barrel a dollar, probably the shale gas and oil production will become unsustainable or uneconomical. But now that understanding is also getting debunked. And some of the producers of the shale gas and oil have started, communicating clearly that so long as the international oil prices are $45 a barrel and above, we will have no issues. We will continue, or we will remain economically viable. So if you take all of these into account, then my own sense is that the ability of OPEC to drive down or drive the prices up will be very limited, and oil prices will remain soft in the near term. Exactly at what level will be very difficult to say, but it is quite unlikely that they will, at least in the near term, go back to anywhere close to $100 a barrel. I mean, $100 a barrel.
All right, thank you for that. We have another question here from Mr. Nitish Sikand. What is the amount of savings that the government would make in interest outgo for every 50 bps drop in interest rates?
Well, that will require some kind of a calculation, and also it depends as to what kind of a borrowing government does, whether government issues a bond of 30-year tenure, whether it borrows money through 10-year tenure, or whether it borrows through 5-year tenure, because each of these bonds will have a different cutoff yield. So I mean on the whole, the trajectory is very clear that if the interest rate regime is becoming softer, or in other words, if monetary policy is becoming more accommodative, whereby the policy rates are going to come down, then clearly the yield on bonds will also come down, and that will obviously reduce the government's cost of borrowing.
All right, those are all the questions that we could take for this particular session. In the end, can I request Dr. Sinha to give us few key highlights or key pointers or a takeaway for our audience from the presentation made? Just to summarize, Dr. Sinha.
Well, I mean, just to summarize, I mean, if one looks at that what kind of a trend that will emerge in FY16 as compared to FY15, say for example, if one looks at the GDP, overall GDP growth, the growth will definitely going to be higher than the growth that we are going to witness in the current fiscal.
Okay.
Fiscal deficit also is likely to be better. Currency will largely be stable. Yield, as I said, would decline. Current account deficit will not pose a danger. Inflation will remain soft. So on the whole, the economy as it steps into FY16 will be on a much firmer ground than what it was on FY15. And if the government continues to show the resolve that it has shown till now, then slowly and gradually getting the economy back to its potential rate of growth, which is anywhere between 7.5 to 8%, can be realized in the medium term, which is over the next 5 years.
All right, great. Thank you so much, Dr. Sinha. We'd also like to thank all of you for your questions today and for attending this session and seminar. As you know, the report was released last week and we've received a lot of queries with regards to the report. You can download the same from our website, which is www.indiaratings.co.in. Also, alerts are available on our LinkedIn and Facebook page. You can follow us on the same. If you would require a copy of the presentation made today during the webinar, you may please send us an email on investor.services@indiaratings.co.in. Thank you so much and you have a great evening.
Thank you.